All right. So here we are at our first ever PowerPoint. I'm here with Joe, my friend that we've been battle buddies for quite a while. First off, let me introduce Joe. Joe's been a part of the community that me and him have both been a part of in real estate, and we decided to go ahead and just practice a little bit here. So what I've developed is a trading course, investing course. With some basic stuff that I have learned. Um, and so this is just our first ever little Zoom that we've had. We said we're going to go ahead and do 4 weeks. And so I've prepared, I believe, 16 slides here to go over. And yeah, let's go ahead and get started. So in this course, I'm going to call this first lesson, this first week, understanding the basics. 3 basics to winning in the markets and life. So, what I've done with this is basically applied investing, trading, and life, kind of like use similar um, examples because I think that what I have here as far as in this first step, it really applies to not just trading, but also investing.
Mhm.
And I think if you can become a good trader, you can become a good investor and vice versa. And also within some of these principles that I would like to share, it's also, I apply it to my own life because I feel like in life itself, there's a lot of examples that you can learn from trading and investing. And so we're going to go over that. And so you may hear that over and over again, and just apply it to whichever one. But I think you can apply it to all three simultaneously. All right, non-financial advice disclaimer. Take a quick second to read that. Obviously, this is basically just me sharing from my experiences here.
Mhm.
So I wanted to start off with my goal in presenting this. First off, I want to help others accelerate their path to success and maybe avoid some of the mistakes that I've made. Um, Also, along with that, I want to build relationships based on fundamental principles. And some of these fundamental principles can apply to life, but they also apply to trading, like I just mentioned. And to learn and become better myself through teaching. I think that's a really big one for me is to just take action and teach others. And I feel like if I can go ahead and um, share what it is that I am trying to do up front, then you know what my intentions are. And so if I fail at what I'm trying to do, then at least you know what my intentions are, and maybe you'll give me a little bit of grace. So also I'd like to invite you to in this journey to success that I'm on. Um, I don't want to go alone. I want to bring a lot of people with me. So also empower and support others who want to create financial freedom and buy back their time. Um, and then lastly, my big life purpose is to upgrade the world, leave the world a better place than I found it. So I'd like to do that with people. And so that's why I'm creating this little trading course right now. All right, so the agenda, what we will learn over the next 4 weeks. What we're going to go over today is understanding the 3 basics of trading. Um, Next week, I'd like to go over risk management and becoming a good bag holder. And
Okay.
then the third week will be technical analysis and looking at charts and how to read trends and support and resistance. All right. And then the last one is have a plan and stick to the plan. All right. All right. So the 3 basics to winning. Number one is follow the money. Um, the roadmap to success is in the math. All right. So we'll go into that here in just a little bit. The next step, this is what we're going to talk about. We're going to go over all three of these one by one, is to build emotional maturity. Controlling your emotions is over half the battle to becoming successful as a trader, as an investor, and I feel like in life, as I get older and older, I realize, how immature I was emotionally in my younger days. And so the more you work on yourself, the better off you're going to become just with
Yeah.
other relationships and in life all in general. So that's why I say you can apply this to life and trading and investing, all three at the same time. And lastly, we're going to go over pain plus reflection equals progress. Failure is not the opposite of success, it's part of success. This is one of my favorite sayings because many times I feel like people feel like if they fail, they have lost. They it's not a win, it's the opposite of success. But in reality, failure is absolutely part of success. And if you're not willing to take risk and fail and get good at failing, then you will never get good at winning. And so pain plus reflection equals progress. All right, so number one, follow the money. To uncover the real story in any situation, you must trace the flow of money. Now, there's a old saying, I think it was in journalism that says follow the money. If you want to find the true story, just follow the money. And so that is very true with what we are going to go into right here. Follow the money is a time-tested saying that reveals the truth behind personal finances, businesses, governments, and even the stock market. And so with this first principle that I want to teach, um, when you look at money, like let's use the example of your personal finances. When you really sit down and look at your personal finances, you will find out what your habits are. You'll find out your strengths and your weaknesses. You'll find out where your deficits are and where your surpluses are. You'll
Hmm.
find out if you're good at saving or if you're there's impulse buying happening. You'll find out, if fast food is your thing. Well, all those things will show up in the actual spreadsheets if you actually track your personal finances. Same thing's true for a business, whether you're trying to start your small business. When you really do the numbers, it's there. All right. And definitely there for governments. But what we're talking about here is like stocks and charts. So when you really look at the numbers and you start follow the tape, and the charts, on the bigger time frames, you'll really start to see a bigger picture. So following the money uncovers hidden patterns. It exposes biases, predicts success or failure, and tells the truth despite all the noise. So a lot of times, especially in investing, you'll get excited about something because of a narrative. Something you read, something you heard, something you watched on YouTube, and that'll get you excited. And that really is noise. When it comes down to trading and to really having a good game plan, you have to follow the numbers, all right? Follow the money. So following the money aids investors to make strategic decisions and avoid emotions. All right, there we go. We're going back to emotions again. So all three of these points are all interlinked together. They all kind of like support each other. And so emotions can really make you a terrible trader, a terrible investor, and a really bad partner in life or a really bad son or daughter. So being emotionally strong is going to be something that we're going to learn about as well. Following the money can give you your greatest edge in the market. And this is something I've learned and tried to develop more and more, but it's called smart money concepts is the type of trading that really follows the big money. So what they do is they look at where the big flows of money is going and they just read those big charts and then they know whether it's an accumulation zone, a manipulation zone, or a distribution zone. And so that's why I have this as one of our number one points as far as in our first beginning of our course here. Do you have any questions about any of this so far, Joe?
Not so far. It's making sense so far. Yeah.
All right, so learning technical analysis, understanding math, prices, charts, and patterns is your greatest edge and gives you confidence when applied properly to trades, investments, and even in life. Technical analysis is just a fancy way of saying follow the money. It involves studying price movements of the past, also referred to as the tape, and coming up with if-then scenarios. So when you look at the tape or the charts, there's this saying, when in doubt, zoom out. And what that means is if you're looking at a shorter time frame and you're confused about something, zoom out to a longer term time frame and then start to develop your if-then scenario. So if-then scenarios are ones that you come up with that involve that stick to your trading plan, but it says if this happens, then I will do this. And then once you do that, you also put in an if-then scenario. If this happens, then I will let the trade run or I will exit out if it goes the opposite direction. So when you really get down to technical analysis, it comes down to math and probabilities. Um, One of the big things that I have learned, let me see if I can find it here. Can- Um, well, I'll go back to, I guess, in technical analysis, when it comes to creating if-then scenarios, you have to have a game plan. And we're going to go over that in the last week of the course, is kind of developing a game plan. But when you're going through and you're looking at charts, you're looking for if-then scenarios, is what you're doing. You're saying to yourself, well, in the past it looked like this happened, and then this happened, and then now you're going to try to duplicate that in real life, in real time. All right, so the trade comes down to charts and rotation of capital first. Let's talk about that. So what is the charts? The charts is the tape. That's what has happened in the past and what, based upon the past, what is most likely to happen in the future. That's the chart portion of it. The rotation of capital is more of the SMC, the smart money concepts type of trading. That's how big money is moving. That's how the whales are moving. So I liken it to like a ship. A big tanker ship takes a very long time to turn. A small little speedboat can do loops and, spin in the water and go all over. So big capital takes a very long time to move their money. It can take them years. It can take them, multiple. It can take them even decades to get a position in a certain asset before they allow it to run. So when I'm talking about rotation of capital, capital never really leaves the markets. If you put all the markets in together, if you put in, you know, um, real estate, stocks, bonds, all of these different assets, it never really leaves. It just rotates between them. So maybe some investors may be more in real estate right now in this cycle than they are in stocks or in bonds, but big money never leaves the market. It just rotates in and out of the market in different markets, right? And throughout different cycles. So rotation of capital is what is one of the main factors, as well as the charts, to determine what the trade should be. Now, I had this all wrong in the beginning. I'm going to give you some of my personal examples. When I first got into investing, I was a big crypto Bitcoiner. And so I was so focused on that economy, all of the crypto stuff. And I got in back in 2020, actually the beginning of 2021, rode it all the way up, but then rode it all the way back down. And basically didn't make any money, lost money all the way because I didn't know very much. But going back to narratives, I was a crypto person and I didn't understand anything. And I was so focused on one asset class that I didn't understand that, people are rotating out of the crypto economy back in 2022 and into other stuff. And I was just like trying to force it to work. I was going against the grain. And then I became a bag holder. I didn't want to be a bag holder. I was in this to make money. I was in this to preserve wealth. I was in this to buy my time back, but I became a bag holder by not by choice, but by default. And so in our second week, I want to go into how to teach us to become good bag holders, where we want to hold these bags and not have to hold these bags because it's sold off so much that we just don't have the guts or the umption to take the loss and rotate our money into another asset. So narratives drive a lot of hype, a lot of videos out on YouTube are mostly all narratives. But what we do want to focus on is the charts. The charts don't lie. Now, the charts don't give you 100% confidence, but they increase your probabilities. And that's where we go back to if-then scenarios. So when you look at charts and you start to get really good at technical analysis, you can start to see patterns and you can start to see things happening and rhyming over and over again within the charts. And there's patterns, there's all different ways to read the charts. But the bottom line is that it's not 100% correct all the time. It can go the opposite. But what it does do is it gives you a much higher probability at becoming a good trader and a long-term investor. And so understanding those two concepts, that rotation of capital and charts, is what really tells you the trade, not the narratives. There's lots of hype out there. I've jumped on the bandwagon of so many different hype plays, and I end up being a bag holder because I wasn't really focused on the charts versus the narratives that were coming out. And it's really easy to get, sucked into those. And so we'll go into that when we go into emotions. You have any questions so far?
So far, I'm so good.
Okay, just go ahead and interject if I'm going too fast
Okay,
or if you have any questions.
will do.
All right, so what makes the markets move on a, you know, on a bigger term time frame? It is fear and greed. Now, some will say supply and demand. Supply and demand definitely play a part, but I think on the what as a trader and as an investor, what one of the big factors that you need to start to think about is how fear and greed work within the markets. So let me just go ahead and read this real quick. Fear and greed is a powerful force that drives the financial markets, particularly evident at their peaks and troughs. At the market peaks, at the market's peak, greed often takes center stage as investors and traders are driven by the desire for greater profits, pushing asset prices to unstable levels. Why are they looking for more profits? Because emotion has come into play. All right. So that's where the greed comes in. Emotions equals greed at the top of the market. Okay. Now, this is also well, it says it right here. This exuberance leads to an overvaluation, creating a bubble that eventually bursts. All right. So greed, 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 all the way up to the top. And then all of a sudden it burst. And then conversely, as at the market's bottom, fear becomes a dominant emotion. Investors and inexperienced traders worry about further losses. They engage in panic selling, driving the prices down to undervalued levels. This cycle of fear and greed is a natural part of market dynamics and offer a great opportunity for savvy investors and traders who can navigate these emotional extremes with discipline and long-term perspective. So the point that I'm trying to get across here is if you understand that fear and greed drives the markets on the longer term charts, on the longer term scale, then you don't have to be a part of the very, very top. You don't have to be the ones that are just holding on and being greedy because you want more gains. And you don't have to be the one panic selling at the bottom. But if you can capture that in between move and you can understand that fear and greed is what's pushing this higher right now, we're in the accumulation zone, or if we're in the distribution zone, then you can understand that there's a spread in there that you can capture, and you don't have to be the smartest person in the world to capture that. You just really need to focus on your emotions and sticking to your plan, understanding who you are, and and you can be successful at this. So right here I have a chart of the cycle of a bubble basically, or the
Mhm.
cycle of the market. So what I'd like to do is just kind of go over this real quick. So life and death cycle of a bubble. A bubble occurs when the price of an asset inflates too much too quickly, whether oil, real estate, stocks, or currencies. Bubbles have the same drivers and the same end game. So this happens like throughout all different types of assets. I mean, it happens everywhere. And so the first part of this is the stealth phase. This is where the smart money sees that this is a hated trade and it is oversold. Okay. And that takes off. Can you see my cursor here?
Hmm.
Okay.
Yep.
So this is the takeoff. This is the launch zone. Okay. Um, and you get in the beginning phases, it doesn't look like a good chart. It looks like a horrible chart. It looks like this over here. If you look to the left, you'll see most often a big old sell-off. So this is a hated trade. As it starts to build a little bit of momentum, institutional investors will get in. This is where the smart money, as they call them, uh, get in, and this is what I want to focus on within our trading. Um, is what is the smart money doing and follow their trades. So as they start to get in, then we go through these different cycles of the market. And most of the public gets in right in this zone right here. During the enthusiasm, we got media attention, then we get into greed, and then there's delusion. We're going up forever, right? Going to the moon, moon boys. All right. And then we hit the new paradigm is that the smart money is starting to scale out. They're take the smart money, these guys over here and the institutional investors, they typically start to scale out. There's a saying that Warren Buffett has, which is be greedy when others are fearful and fearful when others are greedy. And
Hmm.
that's where the smart money has nailed it. They know how to go ahead and take profits. All right. Well, as most retail investors, they don't. So here we go. We're going back down. There's a bull trap, and they've lost all this money. And then it starts to come, there's this rebound, which they call the dead cat bounce. And that dead cat bounce, most of the time, is where you should sell. But a lot of retail, instead, they think it's going up forever. They're still in disillusion state right here. I've
Hmm.
been there. They're still in greed state too, because it used to be this high. This trade was worth $10,000. Now it's only worth $8,000 or
Yep.
whatever the number is. And so they're in disillusion still. And I've been there. I'm not pointing any fingers. I'm pointing the finger of myself right
I've
now. I've been there, right?
been there.
And and so it comes up the dead cat bounce. They should have sold right here, or been like the smart money and start to take profits here. Smart money starts to trim their positions. They never sell all at once. They always take a percentage off, a percentage off, a percentage off as it keeps going up, percentage off. And then as it starts to come down, they don't know that this isn't the top, but they're still taking a percentage off, percentage off, percentage off. And then by the time we hit this fear zone, they're already scaled out. And guess who's left holding the bag? Retail. All the dumb money. That's why they call us dumb money, is because we ride it up and we ride it back down. And then guess what? We sell down here, most of us. That's what capitulation means. Okay. Retail selling, 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 selling. We go into despair and the cycle repeat and the
Hmm.
smart money make more money because this is over here, takeoff zone again. And so guess who's accumulating right after we sold?
Yeah,
Smart
that's
money and institutionals. And so we don't want to fight this pattern. This pattern plays out in real estate, it plays out in the bond market, it plays out in stocks, it plays out in almost every single market. And let me go ahead. There's another chart that's very similar right here. And I want to show you. Oops, sorry. Let's go back. So if you're a trader, see these green zones right here? That's where the money's made is in the green zone. See how it repeats? There's two of them here. There's
Hmm.
another green zone. Okay. So you want to go from being a gambler to becoming a casino owner. If you understand that you don't need to nail the top, you don't need to buy at the bottom, you just need to accumulate in the yellow and let it ride in the green and start to sell in the yellow and red, you can make a lot of money. Okay, so this would be as a trader right here, you're shorting this move down.
Hmm.
As a trader, you're longing this move up. And guess what? It repeats itself. You don't have to hold the bag forever. You don't have to be one of these guys who says diamond hands, you know, because that's just another narrative, really. Like institutionals need to have diamond hands because they have so much money that it takes them a long time to get a position. So, yes, they will let things play for many, many years. But as a small institutional trader, that is one of our superpowers is that we can always get our orders filled. We can go in
Yep.
and out of positions really, really easy. So if you understand this chart right here, this is from the technicaltrader.com. He's one of the guys I watch and have learned a lot from. But his goal is to make, I think, 5 to 12 trades a year. And this is what he's looking at, this move right here. And he goes in with big positions and then he looks to make a short position over here. And he's only focused on a few assets, a few big trades, and that's all he does. Okay? And he just rents and repeats every year, 5 to 12 trades is all he makes. Okay? I'm not saying that's your or my trading strategy, but that's who put this chart together. And this is really interesting too. When you look at the dotted line here, this is the moving averages. And as you see some of these moving averages, this plays out time and time again. This might be your moving average over here too, okay? Just imagine that. But you're trying to focus on that green zone. Buy in the yellow, sell in the yellow, hold in the green, avoid the red zones, okay? Or dollar cost average out if it's in the top, right?
Hmm.
But it's okay if you miss that top. It's okay if you already dollar cost average all the way through that yellow right there, right? It's okay. You don't have to sell at the very top. What you're focused on is this middle zone. All right. So that's the first point is follow the money. The second point that I'd like to really, excuse me, I'd like to drive home is the psychology aspect of trading in life. And that's understanding yourself, understanding your emotions. It's critical. 90% of 90% psychology. Success in trading, investing in life all comes down to perspective and emotional maturity. And as I, got a few more years under my belt than when I was in my early 20s, I've learned that, I was so irrational and so emotional and so out of control. And some of the big life decisions I made were all just emotional immaturity. And as I get older, I realize, wow, I have perspective now. I have understanding. I've had gone through some of these things. Well, it's no different. It's very similar in trading. As you develop your edge and develop your trading strategy or your investing strategy, you will gain emotional maturity. But the more you focus on emotional maturity in the beginning, the greater your edge will be. And so that's why I have it for point number two. Emotional control is essential for successful trading. Fear and greed can lead to impulsive decisions. Recognizing and managing these feelings will greatly improve your outcome. All right, lack of knowing oneself and failure to make the needed adjustments is why 90% of traders fail. All right. So I've literally failed, I think, 3 times, where I have started and stopped and started and stopped. Just gave it up. And I know you've been a part of my journey, so you know this, where I'm like, okay, I can't touch this stuff anymore. I don't know what I'm doing, you know. But 90% of traders fail because they don't know themselves and they don't address their dark side. And that's what I have here. Being willing to take a look at your dark side and make changes accordingly is paramount to becoming successful. And honestly, this is true in life too. Like I was such a mess as a human until I started addressing some of my darker yucky stuff that I don't want to look at in myself. And it's definitely true in trading because those first few attempts that I made at trading in my life, man, I was so emotional and I was losing money and I was doing stupid stuff because of fear, because of greed. It was all fear and greed driving me. And I was the one giving up all those gains to those big, successful traders and investors who had addressed their darker side and have figured it out. So that's why point number two is the psychology of trading. So a refusal to acknowledge, address, and change your emotional weakness is a guaranteed recipe for long-term suffering and loss. And boy, can I attest to that. I mean, I have put way too many losses, got taken way too many losses because of a lack of a willingness to address and change my emotional weaknesses. And I'm still there. This whole course right now, when I said I want to teach and learn along with you, I am not a model student of this at all. I am still working on every single one of these points.
Yeah.
And it's actually presenting this is actually helping me to not be a hypocrite and actually follow what I'm teaching as well. So it's this is my blueprint as well to get better and more successful. So thank you for allowing me to teach you today.
Yeah.
Um, so for point number three, do you have any questions on number two? Basically, it's about
No, that one, yeah. I we've both been through it. That's the same thing I was going through as well, is just at the very beginning making a little bit of money, so I think I'm a genius, and then not actually having a
Mhm.
plan, not actually having a strategy, just doing the vibe trading doesn't really work. So,
No, it doesn't. Yeah, and in reality, like um, it sets you up for more and more failure when you actually do have a little bit of success because when you have a little bit of success, you keep. It's kind of like it really is. It's just gambling. It's being a gambler, because
hmm.
a gambler who gets a little shot of adrenaline at the casino, always comes back,
Yep.
because they had that one adrenaline boost, and so. It's really it comes back to addressing the darker side of ourselves that is fearful, emotional, and I actually want to read this little statement that I heard the other day. It says the ego is the story that you built to survive your fears. And
Yeah.
so, like when we're acting out of our ego and not logic and charts and strategy and edge, and then we're acting out of our ego, which is the story that we told ourselves to survive our fears. And this is one that I am still working on. I want to grow with you guys on this journey to becoming a more successful trader. So I'm not here as a guru. I'm here just as another person trying to master myself as well. So point number three is pain plus reflection equals progress. Tracking your progress and emotions effectively is the key to long-term success. And I'm still struggling with this one, being consistent at journaling. All right, that's what this is. Journaling is a major, is what has given me some of my edge. Is looking back at my own mistakes and saying, okay, I did that once. I don't want to do that again. That was very painful. And how did I get myself into this situation to make this painful decision and go be emotional? And once I've actually started to journal more, I've been
Hmm.
able to identify how crazy I have been, how much I've thrown the charts out the window or just acted on emotion and impulse and just
Yep.
been a really bad trader. A good trader is somebody who sticks to the game plan. A bad trader is somebody who maybe still wins, but doesn't stick to the game plan and doesn't stick to their edge and their trading strategy. So I've been at most of my trading has been a bad trader. When I do get a win, it's not because I've deserved it. It's because I'm stubborn and I just kept trying and trying and trying and whatever. And But this is not, I want to say this. In in trading, especially in trading, I mean, in investing, you can get away with it a lot more, but in trading, this is not something where you, let's say, your family or somebody buys a box of something from IKEA, and now you got to go home and put it together. Well, men and many people will just throw out, they won't even look at the directions. They'll just figure it out and then they'll go back and look at it. Well, in trading, you can't really, like, that's a really good way to blow up your account.
Oh
Okay,
yeah.
is to just try to figure it out as you go along. You really need to follow the directions. And so that's where, in week number 4, I want to develop something that we can all start to follow and hold each other accountable to. That will be our plan. That's what we're going to stick to. That's our trading edge. Okay. And so we want to be the type of investor, trader, human being that has a guideline, has some rules set up for ourselves so that we can be successful. And part of those rules is to be consistent and to reflect on yourself. And like I said, these are all interlinking, all three of these points interlink. So like when you're looking at the emotional side of things, you can start to really understand who you are through journaling. When you just, pull up a new how I journal. I'll give you an example of how I journal. I just talk. I don't write because I don't like writing. I'm not a very good writer and stuff. So I'll just talk it out and put it into a Word document using the audio type option in Word. And I'll just put my thoughts out there on the day or for the week or whatever. And that's really starting to help me. And I need to be more consistent at it. This is a point out of all three. This is the one that I got to continue to work on the most is to really be consistent at it. So what does it do? It helps identify weaknesses. Okay. Um, it helps you track your progress because I've found that when I go back and I look at my journal when I'm having a bad day, I can go back and look at some wins or look at where I used to be. So, it does help a lot when you go back and read it too. It improves your decision making. If you know you have to journal, you may not,
Yeah.
you know, you may make better decisions. And then it enhances discipline as well. If you're going to be journaling about it, you're going to want to journal good things, not bad things.
Right, yeah.
So failure is not the opposite of success, it's part of success. With journaling, you're going to have failures, you're going to have losses. Now, what you want to do is minimize those losses. What you want to do is be a good trader and have losses, but not have big losses. You want to stick to your risk management plan. You want to learn how to take a loss. Be a good trader and take the loss. It's okay to lose. Failure, losses is part of trading. It's part of investing. It's part of life. In life, we don't always win the first time we try. In fact, most of the time we lose a lot before we get a win. And if it was easy, everybody would be doing it. But it's not easy. It takes discipline. So, essential journaling practices, record your emotions. Um, it's okay to be honest with yourself and let it out. Nobody else has to read this. It's just for you. Okay. Uh, Note your trade outcomes. What happened when you did such and such. Okay, this time it worked out, this time it didn't work out. I have a 11-year-old son, and I often tell him that we don't learn as much from our wins as we learn from our
Mm-mm.
losses.
Hmm.
So let's write those losses down and so that we can go and reflect on them. So it also helps you with your strategy. You can go back and be like, okay, this worked this time, but this time it didn't work. What was different? What did I do differently? So you can kind of tweak your strategy as well. And then, the big question you should be always asking yourself when you journal is, did you stick to the plan? And if you stuck to the plan, you're a good trader. If you didn't stick to the plan, you're a bad trader. Doesn't matter if you won or you lost. So that's a big one. And then that's it. This is slide number 16. So this is just the summary. If you want success in trading and investing and in life, I feel like you got to do this. You got to follow the money. Because in your life, like money dictates so much of your life. Like we go to
Hmm.
work every single day. So if you're not a good money manager of your finances, your life, you're going to be stuck being a wage slave, or you're going to be stuck always struggling with money. Every time you get it, it disappears. So in life, follow the money. In investments, follow the money. What are they doing with their money? You know, and what is big money doing? What is the smart money doing? Follow that type of money. And same thing in trades, in the charts. When you're trying to see if this is a good buy or a bad buy, when should I buy? How long do I need to wait? Which chart should I be looking at? Follow the money. Okay. So to understand the big picture, you need to see where the money is going. Once you understand this, you go from a gambler to owning the casino. And that's where we all want to be. We want to be the casino owners. We want to be the business owners. We don't want to be the guy trading his time for money. And I think if we focus on the big picture, this is a long-term strategy. No matter who you are, if you're just an average Joe working at a construction site somewhere, or a truck driver somewhere, or you're trading your time for money at the local uh, convenience store, you can start to develop this plan and put this into place and go from, you know, focusing on these three things. And before you know it, you can stop being the gambler. Um, I think, I think what's his name, Facebook said it best. He said, um, Mark Zuckerberg said, the biggest risk is to not take any risk.
Hmm.
And so if you're investing in your, financial literacy and you are starting to think about trading or investing, you're investing in yourself, and that is risky. That is hard. That takes education, that takes motivation, that takes emotional maturity. But the biggest risk is to just continue to work your day job and not learn and not take risk and not try. And so, give yourself a high five for doing that. And then the last, the middle point, the second point that I want you guys to really think about is build emotional maturity. In life or in investing, you must first understand your weaknesses in order to have lasting and meaningful success. And I forget if it was in The Art of War or something that says something about that he who does not know his enemy will be defeated in every battle.
Hmm.
And in many ways, we are our own worst enemy. And as we start to understand who we are and dig deep into those dark spots in our life and understand why we are the way we are, why we are so emotional, why we're so fearful, why we're so greedy, why we're so spontaneous or impulsive, um, then we can start to work on those things and double down on them a little bit and create new habits. Um, so emotional maturity, number two. And lastly, learn from your mistakes. If you can get 1% better every day by looking at what you've done and how you're going to critique that and make it better, pain plus reflection equals progress. These are not just like little sayings that I want to tell other people. These are sayings that I have written all over my desk here and help me remember that I don't want to be the guy I was yesterday. I want to be
Hmm.
better. And so failure to document your wins and losses will lead to lack of understanding of why you're winning or losing and cap your future progress. And if we want future progress, great big things, we all should be dreaming really, really, really big. Then we really do need to be documenting our wins and our losses because it will just help us understand ourselves better. So all three of these points kind of flow together to help you hopefully get better at life, get better at investing, and get better at trading. And week number two, we're going to go over um, what was week number two? Let's go back and look at it real quick. I forget. I've got all these weeks planned out, and I think we've got ourselves a pretty good trading course, a 4 week trading course. Um, one more. So risk management.
Risk management. There it is.
Yes, becoming a good bag
Good bag.
holder. So what we want to focus on is how to mitigate risk in um and in my so just a little sneak peek into next week. In my journey, I've become a really bad bag holder. I held on when I should have sold all the way back down. I've had
Same.
some really nice wins, um, but they weren't wins because I didn't take profits and because I was greedy. And so what I would like to do is develop a strategy that says, hey, if I don't do this, then this is going to happen. And do I really want to do that? And so we want to focus on the least amount of pain, in trading. You want to focus on, being successful and making money. That's why we're here doing this right now, buying our time back. And so you can't, you, if it's okay to hold something long term, it's okay to be an investor and have something in your portfolio for years, you know, but we want to look at the macroeconomic cycles that are happening, and we want to buy them at the right time, not buy them and then refuse to sell them and then end up holding them for a long time because we just can't stand the loss.
Yeah.
So that's what I want to go over when it comes to risk management. And this is a big one that I'm still working on. So once again, I'm going to be learning with as I teach this. I'm still, a bit hypocritical in some of these areas. So I'm going to keep trying to improve and get a little bit better. And so that's my presentation for you.
That was a great presentation. Yeah.
Any thoughts or questions or
No, I liked it a lot. It's very informative and it's not too it's not the drinking from a fire hose kind of thing. It's broken up into, bite-sized manageable sections, so I like it a lot. The
awesome.
the journaling thing I need to get on too, because that's I like the emotional side of things is sometimes hard for that to be like tangible. Like, am I feeling emotional right now, or am I doing this trade because it's a good trade? It's like sometimes a little bit of both. But like if you're writing it down and journaling, I like that a lot. And I've never done that a single day in my life. So that's already something I learned today just off this first one. So that's big.
Good, yeah. And I would encourage you, you don't have to necessarily go get a special journal or anything like that. I've
Hmm.
got this special journal that I haven't really used that much. It's got some really good insight for me, but I have had a hard time being consistent with that. But even if you can just try to be understanding of yourself right now and just say, what I'm going to do is I'm going to promise to myself that I'm going to do a journal, even if you're not doing any trades or whatever, even if I'm going to journal for myself once a week, every Sunday or something like that. If you can start to just do that and then turn that into twice a week or three times or every day,
Hmm.
if you can start to do that, that's going to be one of your biggest gifts to yourself. And I know it's already like it's kind of like sometimes the most important things get pushed off to the sidelines because we're so busy and entertained and amused with everything around us, but like it really is one of the biggest things that can help you in life is to start journaling. And I know that, and I still struggle doing it because it's like, oh, I got to go do this, but I got to switch it from I got to I get to, and,
Yeah.
and change
Yep.
the perspective because it's a big gift when you can actually go and put your thoughts out and start to learn from those, things that you did throughout the day. So,
Yeah, no,
or-
I'm gonna start doing that at least. I mean, at least every time I do like a trade or buy, crypto or anything, it's just at least just record it, just write it down what you did. Like that's what I want to start doing is just if I
yeah,
put money into Fidelity or if I did, anything with that, just because I don't track it like at all. There's zero accountability there on my end. So
right. Yeah.
if I start
Yeah,
with
I,
even,
I I
one
would like
thing.
to I don't know where this will evolve into, but it'd be interesting to see the whole Battle Buddy program I think
Yeah.
is really important because we are our worst enemy, and many times we do need other people around us to help us
A little
because
accountability partner. Yeah, definitely.
I mean, I'm even me doing this like right now, even this whole
Yeah.
presentation is helping me
Oh,
become
I'm so glad.
more
Yeah,
more serious about this
definitely.
and how dare I teach others and not do it myself,
Yeah.
and so like this is a part of me being like you just taking this and other people watching this is helping me be more accountable to myself to journal to
Yeah.
be
Same here.
more emotionally mature and so yeah, I'm excited about where this can lead for us, so
Definitely.
thanks for joining me today.
Yeah, thank you. This has been great. Because that's something I can implement right now today is just start journaling. Because I was doing the same thing with like tracking what I ate when I was doing like
Hmm.
personal training and stuff, and it's the same concept. Like you'll literally like not eat that donut because you know you're gonna have to write it down, and it'd be the same thing with budgeting.
Yes.
I just don't do
Yes.
it. I'm just like,
Yes.
$30 doesn't really hurt me that much. Just spend it on the credit card, forget about it. And it's like, no,
Yeah.
write it down, and you'll be kicking yourself later. So
Well, and you bring up a really good point because I mean one of the things that I have on my 2026 goal list is to get healthier.
yeah,
Um, I've got the dad bod going on now and I'm just like completely like eat whatever most of the time. And I don't feel that great doing that.
yeah,
And so I know I have to make and I am, which is pretty exciting making some more health conscious decisions. And so
good,
you're
yeah,
you're right. Like journaling, it could be your journal. It doesn't have to be just your trading journal. But I do encourage that aspect of it if you're going to get serious about trading. But health and life and goals, it can all go into the same book or spreadsheet or what however you want to do it. But it's the same concept basically. You're like you just mentioned, you hit the nail on the head.
I like it.
So, I look forward to seeing if we can build a community around these ideas and help each
Definitely,
other along the
my
way.
buddy Jasper, I'm living with, wants to hop on the next one, so we'll have
Okay.
another guy. We'll have another one more.
Well, what I would like to do, I think maybe next week we may have a few other people, like including your
Sure.
buddy Jasper, which is
Yeah.
absolutely fine. Um, what we would do I should have that all put together. So next Wednesday we'll go over risk management and how
Perfect.
to become a good bag holder. Um, so yeah, awesome. Well, thanks for joining us, guys. I'm gonna go ahead and